South Korea's financial markets have stabilised after the lifting of martial law just a few hours after it was imposed, but the won remains vulnerable to political instability and a national strike threat. Australian GDP growth is more solid than its top-line figures suggest. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ India economist Dhiraj dismantles India's food inflation trends to find there's more than just the weather and climate at work.
There is a set of variables which includes things like agricultural input costs, food demand, per capita income growth, and logistical costs, which offer a superior explanation for the longer-term food inflation trend, including the surge in the last 5 years.
But first, in 5 and 5 with ANZ, global markets and investors are getting over the shock of the declaration of martial law in South Korea and its rescinding just hours later yesterday. Stocks and bonds overnight were mixed, and the South Korean won recovered some ground as investors and traders consider what next for Asia's fourth largest economy. Here's ANZ's Head of Asia Research, Koon Go.
Thankfully, the martial law was overturned, and we did see some respite in the won, but it's still trading at a level that was weaker before the martial law was imposed. Near term, I suspect there's going to be further downside pressure on the won, as we are likely going to be entering a period of some uncertainty regarding the tenure of the President Yoon. And we could well see foreign equity outflows in the near term on the back of this uncertainty, which will weigh on the won.
The US dollar index was down 0.2% at 4 a.m. Sydney-Melbourne time, while the Aussie dollar was down 0.72% at 64.37 US cents. More on that in a minute. The Kiwi dollar was down 0.27% at 58.65 US cents. Number 2. So foreign investors may reconsider their holdings in Korean stocks, but there's another set of investors to watch, says Koon.
Given the uncertain situation in the next few months, we could well see Korean households decide to allocate more of the investments offshore, which will further put some downward pressure on the won.
Number 3. The political crisis in South Korea and a threatened national strike to force the removal or resignation of the president have come at a delicate time for the economy. Here's Koon again.
The Korean economy itself is slowing, which is why the Bank of Korea has cut rates twice. But its export sector is still holding up quite well, as Korea continues to be a beneficiary of the positive semiconductor cycle. But as with any economy, if there is any hint of uncertainty, whether it's domestic or external, that can have an impact on confidence, and that tends to impact on business decision making. And if this threatened strike were to go ahead, then again this will create even further near-term uncertainty, which will weigh on growth.
Number 4. Australia's GDP growth in the September quarter versus the June quarter was 0.3% in data released yesterday. That was a touch below market expectations, but the detail of the data was more positive, says ANZ Australia senior economist Adelaide Timbrell.
But upward revisions in the previous data creates a stronger household financial position than was previously indicated. So on the one hand, we're seeing very little growth, particularly in the private sector, which actually saw a detraction of 0.3 percentage points from GDP growth. But on that other hand, we're seeing that households are actually in a stronger position than we thought, with a 3.2% savings ratio up from 2.4% last quarter, but revised from 0.6% last quarter. We're also seeing some encouraging signs of disinflation, with the slowing of unit labour cost growth from 5.5% yearly to 4.3%.
Number 5. So what might the Reserve Bank of Australia think of these figures? Here's Adelaide again.
The significance of the weak Q3 GDP headline numbers for the Reserve Bank are going to be reduced by the fact that we are seeing that stronger household position. The revisions in both discretionary spending and household savings show a stronger household behaviour over the last year, not just the last quarter. So that's going to make the interpretation of this data much more nuanced than it would be usually. The rest of the economy, though, the data is more clear. The public sector is adding a lot of economic growth through a huge jump in government investment of 6.3% quarter on quarter, which added 0.3 percentage points to GDP growth. And government consumption was also boosted by electricity rebates, and it was also contributing 0.3 percentage points to growth.
Adelaide Timbrell there. Now in our bonus deep dive interview, ANZ India economist Dhiraj dismantles India's food inflation trends and finds out there's more than just the weather and climate at work.
The general discourse on food inflation in recent quarters has been that most of it is because of weather, whether it's deficient rains or a glut of rains, or it's the heat waves, average surface temperatures rising. But we think that the longer-term food inflation trend actually warrants a deeper analysis, and it seems to suggest it's a lot more than weather. So if you look at the last 5 years, food inflation has been high across a breadth of items in the CPI basket. So it's been broad based and the surge has been unusual. Even though if you look at most weather related variables, whether it's rains or heat waves, they have not been as bad as they were, let's say, in the 5 preceding years when inflation was still falling. So this does not add up. So we were forced to look at a broader set of variables and we arrived at a conclusion that there is a set of variables which includes things like agricultural input costs, food demand, per capita income growth, and logistical costs, which offer a superior explanation for the longer term food inflation trend, including the surge in the last 5 years.
Let's talk about the costs of getting food from the farm to the consumer. What's going on there to create inflation?
Well, two factors there. First, of course, we know that agricultural input costs were broadly in a decline since 2012 until about 2018 or 19. At the same time, food inflation in India also experienced a near secular decline. And when these agricultural input costs started rising in 2019, with a lagged effect, food inflation in India also started to rise. Unfortunately, during pandemic, due to supply chain disruptions, the commodity prices had inched up for some of these items. And then came, of course, the 2022 Russia-Ukraine war, which sort of rattled across commodity markets. And therefore, there was a significant shock to agricultural input costs everywhere across the world. And of course, in India's case, the impact could be often delayed and distorted because there's a significant public policy intervention in the farm sector inputs towards subsidies. But eventually, costs do catch up, and we find with a lag of about 14 months, agricultural input cost inflation does reflect in food prices. So that's a long lag which can be easily missed, but the relationship is pretty strong. That linear correlation is about 70%, right? The second reason, of course, is what's happening to logistical costs. So this is about how food is becoming costlier to produce at the farms, and the second is how it's becoming costlier for food to be transported from wholesalers to retailers or from farm to the consumers, because we know that the 2022 commodity price shock also meant fuel prices surged in the economy, and that is reflecting in high food trade margins in India. So if you look at the difference between retail and wholesale prices, that has been significantly elevated in the last few years and kind of sticky. And they have a very strong correlation with diesel prices in India, average diesel prices. So we do think that there's a significant component of logistical costs as well as farm input costs in keeping food inflation elevated.
Is there a trend that can continue on of higher food inflation, or have those shocks gone through the system now?
I think there is a good news there. So we have monitored these variables in the last few quarters, in the last few months, and what we find is that a lot of these variables, whether it's logistical costs due to global commodity prices of fuel, or whether it's agricultural input costs, they have all tremendously eased. For example, input cost inflation, the farm input cost inflation is trending negatively now. And we think that if the previous lags are to hold, then in 2025, food inflation can decisively fall, which means that the Reserve Bank of India does not really have to bank on luck or weather to be sure that food inflation will come down.
Dhiraj Nimni. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, December the 5th. Catch you tomorrow with a preview of the all-important US non-farm payroll figures tomorrow night. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.